Recording работает же, Алия?
Hello, Alimshan.
Hello, hello. I just successfully connected back. I don't know what happened to Zoom. Okay.
Professor, my question was, if we practically just calculate the way how it was like here, just adding up like current assets, plant and equipment. Current assets plus plant and equipment plus goodwill minus liabilities and plus the fair value adjustment with the same answer.
No. We are not adding the goodwill. We are not calculating the goodwill in here. We are not getting into consideration the goodwill that he got. This is the goodwill belongs to this company when he started at the beginning. Now we are calculating our own goodwill. Imagine that I'm purchasing, now I'm acquiring this business for 600 million from you. And this is your goodwill when you purchase this from the Jaras or at the beginning when you started business.
So the definition of goodwill was like total assets minus liabilities.
Definition of
goodwill, in excess what we pay to net assets.
Over the fair value of identifiable net assets, asset minus liabilities, acquired in a business acquisition. Okay. This is the condition that it is appearing when you acquire it. It appears from the price. Why it appears? Why you are ready to pay higher price than the net value of the asset? Because of the certain reasons. The reasons are the loyalty the company has, the customer the company has it. Second, the third, it may have some asset that has not been disclosed in the balance sheet. You're hearing me, Islam?
Yes.
So the goodwill is not, for example, this is way when the goodwill is calculated only if you purchase it. The old goodwill should be ignored. The old goodwill should be excluded from the calculation of the new goodwill.
Okay. So what I'm still kind of trying to get figure out like what is kind of this qualified to be identifiable assets, because what I was like in my mind was like total assets and plus fair value adjustments and minus that liabilities would come up with excess price that we pay. And now I'm thinking about this identifiable.
Here, Islam. Look at the definition of the goodwill. It's identifiable asset, yes, or the fair value identified, but the goodwill is in the is classified as unidentifiable.
Okay.
Here's the definition for you. Unidentifiable asset is an intangible asset. That is the example of the goodwill. And the goodwill basically is calculated for you when you purchase it. But when you sell it, the person who purchased from you, the person who acquires from you, he doesn't take into consideration your goodwill.
I see.
It's kind of showing how much you paid for the reputation of the company, how much you valued for it.
So it also relates to the other intangible assets then?
Or other intangible, the one that are unidentifiable.
Yeah, so intangibles are also not identifiable, right?
No. Not all of them. Look, intangible assets are divided into two parts. One is identifiable, the other one non-identifiable.
Okay. All right.
The one that are identifiable, you should include it because you can give them value, certain value or this. By giving some estimation.
Okay, makes sense.
Okay.
Thanks.
You're welcome. So this is part we already discussed. We said that you acquirer, the one who buys the company, he's certainly paying more for some reasons, like why he pays. Like he can pay for reputation, for the customer loyalty, because he values that this company has got really big customer loyalty and the reputation is very high, and maybe there are some identifiable asset that has not been disclosed. So certainly he accepts that he is paying a higher amount, and he cannot identify properly what that amount is going to, but he's given, this is for all goodwill, and he just gives in the value for it. And especially this is a notation for you when you calculate using some ratios, when you calculate a liquidity position or the leverage position of the company, you should exclude, you should take out the goodwill itself in order to come up with a proper realistic picture of the position in terms of leverage, in terms of the liquidity of the company. In any way, in the liquidity, you do not include it, but when it comes to the leverage, you include it, like for solvency issue. So financial assets, let us talk about the financial assets. There are the instruments that are contract that give you a rise to both financial asset of the entity and the financial liability of or equity instrument. So financial instrument can be found on the asset side and the liability side as well. So the examples are stocks, bonds, derivatives, loans, and receivables. Instruments that are measured actually in historical cost, amortized cost, and the fair value. So it depends what purpose you buy it. In that condition, you will use the estimation to record in your balance sheet. The one purpose is held to maturity securities. The other one is trading securities and available for sale securities. So these are the three things. These are the three classification of your financial assets mainly. So when it comes to held to maturity security, you buy a certain debt instrument, you keep it with the fixed income like interest payments and interest coupon payment. You just keep it till the end. No matter what happens to you, no matter what will be the value of this equities changing, you are going to keep this with you till the end. So till the maturity comes on. So you will not resell it, you will not do something, you will just keep, you will receive your payments, you'll be satisfied. Even, for example, interest rate falls dramatically, that will increase the value of the bond. We know there is a inverse relationship between bond value and or debt instrument and the interest. As the interest falls, the value of that debt interest increases. So you will not sell this equity. You will not sell this debt instrument. You will not sell this financial asset. Even the interest rate falls dramatically, it gives you a good opportunity to catch up, a good markup actually. So you bought this certain debt instrument, you're gonna keep it till the maturity. This is the definition of the held to maturity securities. When it comes to the trading and available for sale securities, trading securities, you buy it with a certain purpose to resell it, to get some benefit from it, like, and they can be debt or equity securities. And there's this type of securities are recorded as fair value. Look, the held to maturity is recorded as an amortized cost, as a historical cost. But when it comes to the trading security, they're recorded or reported on basis of fair value, the market price. So unrealized gains and losses will be recognized in the income statement as well. So for example, if you bought a bond, you're keeping this bond with a purpose to resell it. You're aimed that the bond value will be appreciated. You're expecting that the interest rate will fall. For example, can you give me an example? When do you expect the bond value will fall? In what cases? In the boom, or in the crisis? let's say not the crisis, during the crisis, it's after the crisis period. So what happens after the crisis period, guys? How the government stimulates the economy?
Monetary policies.
Yeah, one of them reducing interest rate. Yes.
Uh-huh.
So they reduce the interest rate to attract more customers to borrow the money. So when they reduce the interest rate, they definitely affecting the debt market. So debt market instrument, they will be increasing in value. In this
Yes,
case.
inverse relationship.
Yeah, this is we expect in theory, but how it comes in reality, but sometimes it comes up with the theory it match with the reality. So in here we expect that's why we buy the bond, we keep it with the purpose that the interest rate will fall down, and later on we'll resell it to make the profit on that, to make the markup. So this is the main aim, to keep trading securities, to buy the trading securities. Another examples are derivative instruments, like options, call options, put options, the warrants, the future contracts and forward contracts. These are all bought and classified in trading securities with the purpose to resell it, to make some money. Okay, there's a third part, classification. So our financial assets is classified into three parts. One is held to maturity, trading securities. Held to maturity, we're keeping our securities till the end without any aim to resell it. Trading security, we are buying to resell it to get some profit. But when it comes to available for sale securities, are debt and equity securities that are not expected to be held to maturity or traded in the near term. So you buy it, let's say 10 years bond maturity. However, you're not willing to resell it, to trade it within 2 years. Maybe after 2 years, you will think, when you try to realize some gains, you will see that there is a gain, there is a opportunity to earn when you sell the security back, then you just sell it. So this is the third category of it, how it works. Okay, this is the summary of the classification, the measurement base of financial. So trading security and available for sale securities and derivatives, they are all estimated fair value. Held to maturity securities, they're estimated at amortized cost. That, you know, what's the amortization cost, how it's measured. Amortization cost is always depreciation, the principal amount plus interest payment. You amortize it like the loan. And loans and receivables, they're at historical cost, actually.
Professor,
Yes.
the relationship to derivatives, we said, is that related to callable and callable bonds and the reinvestment risk?
Callable bonds, you mean the convertible bonds?
Yes, I mean, as you mentioned about the interest rate, how it changes.
Yes.
And we were talking about the trading securities, so I'm thinking about the when you enter to the contract and for example, if the rate changes, the investor can return the bond, for example, and use as it is like as a like priority in making, because the like conditions in the capital market change due to the interest rate. Does that relate to that one?
It depends, you know. No, actually, I will not relate to any of it, because callable bonds has got a different future. For example, you record your purchases with your purpose. If your purpose to trade, to earn money on it, like within a short period of time, then you're gonna record it in trading securities. But you want to get a callable bond. Why you buy the callable bond? Maybe they offer higher return, but with the risk here that they will be called back, then you might be recording into available for sale securities. You might not expect, you make some expectation that the volatility of interest will take place after 3 years or 4 years. So everything will depend on your estimation, how it will be called back, this callable bond. So if you are buying a certain security with the purpose to trade in a short-term period, let's say within 1 year, within 1 or maximum 2 years, then you're gonna put it into trading securities. But if you buy a security, let's say I'm not gonna trade it and I'm not gonna keep it till the maturity. The maturity is 10 years, but the maximum I'm gonna keep until 5 years. Then you can put it into available for sale securities. But when it comes to the derivatives, or sorry, when it comes to the held to maturity, you're buying a certain bond that you're sure that you're gonna keep till the maturity. But callable bonds, there is no guarantee that it will be until the maturity. So it can expire at any time when the issuer can call it actually.
I see. Okay.
Okay, I want to give you example in here. Can everyone see Excel?
Yes.
Okay, we are having balance sheet in here. We are having equity, assets, and this is the income statement, like interest income and unrealized gain losses. Let's say we are purchasing 5 million semi bonds, like the bonds that are semi-annually with a 10% coupon rate that will pay us 250,000 of interest income. Okay, we are purchasing bonds with a 10 years bond. Okay, first of all, there are 3 scenarios are given. One is trading, the another one available for sale, the other one is held to maturity. So when it's a trading, which means that you are purchasing with a purpose to resell it, 5 million. Okay, 5 million here in the second scenario. You purchase not to trade within a shorter period of time, but not to held to the maturity as well. And the third scenario, you're purchasing to keep till the maturity, till the end of the maturity. This is the scenario. And of course, you are receiving the interest payment, the interest income on it from each, no matter with what purpose you buy, but every 6 months, you're going to receive this interest. Every 6 months, you're going to receive this interest. Every 6 months, in all 3 scenarios, you're going to receive this interest. Okay? And in first case, we have to have some balance. Like when we purchase our securities, the bonds for 5 million, and it should be kind of balanced with our equity. So we should write 5 million here as well in paid-in capital, okay? In all 3 scenarios, they should be balanced. Then what we do, when we receive this interest income, it's on the equity side, we should record a cash receivable as well because we're receiving it. So our cash will receive. So in all 3 cases, same. So all the activities that we're recording, they're performed in the same way. So they're affecting balance sheet in the same way until some point. So this is how it looks like. Now imagine interest rate falls. Int falls. That will lead the market value of the bond to appreciate to 6 million. We said there is an inverse relationship between the interest rate and the bond value. As interest rate falls, the bond value increases. So in this case, the bond appreciated to 6 million. So our gain, in the first scenario, our purpose is to trade, isn't it? So we will try to trade it. When we trade it, when we sell it, we're gonna make a profit of gains of 1 million. So total net income will be equal to, in this case, This is our first scenario. And of course, net income, let's say there is, imagine for simplicity, there is no shareholders who are expecting from us dividends. So, if those money that are not paid as a dividend, which means they will go as additional to retained earnings. So our retained earnings will be added by this amount. In total, of course, on the asset side, we will have a gain as well because we gained 1 million. So our security should be updated. You remember from the slides that the trading is recorded at its fair value. Now the fair value of the bond is 6 million. So net fair value of assets, and we are imagining that we don't have any liabilities, guys. We don't have shareholders equity, so shareholders dividend payment, and we don't have any liabilities in case. So our net value of fair assets are equal just summation of this. And our total equity is equal summation of paid in capital and retained earnings. So this is how we treat the first scenario with the trading. If there is an increase in the value of assets. But when it comes to the second, this is we keep just with the purpose to trade. Sorry, not to trade and not to keep till the end of the maturity. So which means our net income will be equal in here because we are not gaining from trading anything in a short period of time. So our net income will be 250,000. And we will have in here other comprehensive income in the equity side. In the equity side, there is an additional variable that affects the equity. It is other comprehensive income. So in here, we should come up with some additional amount. What was affected? So first, we received net income as 250,000. To retain earnings, 250,000. Because this is additional that we earn it. And we receive a gain we got from the sale. Still, we're gonna sell it. We said we're gonna keep it and sell it later, which is 1 million. And this will be recorded guys. Can you hear me? Because my internet comes and goes.
Yes, why we have in the sixth row in the available for sale 100,000?
Oh, sorry, it's a by mistake. Should be 1 million. It's 1 million. So because my internet is really today, I don't know what's going on with that. So it's a 1 million of gain because it is the gain means I didn't sell it yet, but it's showing me the value, like it's appreciated. Okay. I didn't sell it. Are you with me, guys?
Yes, yes.
In the second scenario, I'm not selling it. I'm just keeping with me because I will sell it later. But still, my security should be recorded at its fair value. So other comprehensive income should include this 1 million in order to make balance in the equity side. Because I cannot put it in the retained earnings because I have not earned it as an income because I have not traded. I didn't buy this security with the purpose to trade. I'm just keeping. However, it is increased on the asset side in terms of fair value. It is appreciated. Now it should be balanced with the equity side. So I'm adding it to other comprehensive income account in the equity side. So my total value will
It
be
should
equal.
be 1 million too.
Yeah, it's 1 million. I'm gonna correct it. I'm gonna
Okay.
correct it. It's 1 million as well. And this is for the second scenario. When it comes to the third scenario, in the third scenario, we said held to maturity, no matter what happens, if the price is, if the interest is appreciate, went down or increase, I don't care, because my aim is to keep till the maturity. I'm gonna receive my face value and interest payment every monthly, every 6 months. This is what I'm more concerned about. So if this is so, my historical cost, my amortization cost for the held to maturity will be equal 5 million plus 250,000, and my equity side to retain earnings, because I don't care the appreciation of interest, nothing. My net income will be 250,000 in here, and it will be additional to my retained earnings, this net income. And my total equity will be equal to the summation of this, which is giving me a balance between total equity and total assets. We are assuming that we don't have any total liability. Any questions, guys? Okay. So this is the table which is given that we calculated in here. The example we gone with the trading and available for sale and held to maturity. When it comes to long-term financial liabilities, they're mostly like bank loans, notes payable, and the bonds payable and derivatives, and they are mostly amortized at cost. Which means that we're treating them with amortization cost methodology, and which is amortization cost is equal to the issue of price minus any principal payments plus any amortized discount or minus any amortized premium. This is normal thing that we're doing in amortization table. You should remember from your financial courses. We haven't done any amortization table, but you should know it, I expect. So when it comes to deferred tax liability, we say that it is the liabilities that you owe to the government. When we say that before the tax liability comes due, you estimate, and the government estimate on one side. If it doesn't match, if the government estimation is much more higher, that means that your tax liability will be paying higher than that you have estimated. So you put them as deferred tax liabilities there. Okay, coming to components of the shareholders' equity, we know that owner's equity is the difference between the asset and liability, or in other words, it just derives the residual interest in asset that remains after subtraction the liabilities. The owner's equity includes contributed capital, preferred stock, the treasury stock, retained earnings, non-controlling interest, and accumulated other comprehensive income. So contributed capital is the amount that's contributed by equity shareholders at a par value. And when it comes to another thing that is we call authorized shares, these are the number of the shares the companies they're allowed to issue, and outstanding shares and issued shares, they are on basic, they should be equal. If they are not equal, it means there is a difference, and that difference come up with the treasury stock. And the treasury stock are the stock that are issued with the purpose to buy back. And when it comes to the preferred stock, stock that has got certain rights and privileges, but not conferred by the common stock. For example, preferred shareholders are paid dividends at a specified rate at a fixed amount, and usually they are expressed as a percentage of par value, and they are not changing as net income changes. So no matter what happens to your net income, you're gonna pay a certain amount of dividends. However, they don't have any rights to vote in terms of board of director. And common stock as well, the preferred stock, they're perpetual in money, they have indefinite life, in contrast to the bonds, in contrast to the debt instruments. Coming to non-controlling interest is the minority shareholders' share of the net assets of subsidiary that is not wholly owned by the parent. However, when the balance sheet is consolidated, it shows the 100% of the total equity. Even there is a non-controlling interest, like you own only the minority, you own of subsidiary company, or your ownership is only 30%. And when you disclose the financial statement, you disclose it fully, like for 100% as ownership. So treasury stock, we said you're issuing the stock with a purpose to rebuy back. And as we saw that the treasury stock, how do they affect the EPS, the treasury stock?
How to calculate EPS?
No, how do they affect the EPS? What happens to EPS when you buy back the treasury stock?
They
Will be
dilute
higher because
the
the amount,
denominator.
One more time, Islam.
it will be higher because if we buy back, the number of shares will be less. EPS will be higher.
Yes, it increases our earnings per share. Why? Because the number of the share is being reduced. In other words, as the Madhyar said, is dilution. There is a dilution goes with the share, like it dilutes, it reduces the number of shares. So accumulated other comprehensive income, it includes all changes in stockholders' except for the transaction recognized in the income statement, and transactions which are the shareholders issuing the stock, reacquiring and paying dividends. So as discussed in the topic review, understanding the income statement, the comprehensive income aggregate is the net income and the certain special transactions that are not reported on the income statement. So comprehensive income is equal to the net income plus other comprehensive income. So changes in stockholders' equity is just summary of transactions that increase or decrease the equity account for the period. And statement includes transaction with the shareholders, reconciles with the beginning and the ending balance of each equity account, including capital stock, addition parent capital, retained earnings, and accumulated other comprehensive income. So in addition to this, there is other comprehensive income that are disclosed. These are unrealized gain and losses from available sale and securities. Okay, if you remember from the scenarios, other comprehensive income is affected only from available from sale securities, not from the trading securities and not from the held to maturity security. It can be affected as well from hedging the derivative for foreign currency translation or adjustment for minimum pension liability. This is the example of statement in stockholders' equity, like beginning balance, net income is given, unrealized loss or available for sale security, so there is a loss, loss from the hedging and minimum pension liability, so cumulative translation adjustments, so there are some gains, and comprehensive income, and issuance of the common stock, and then there is a repurchase of common stock like treasury stocks, and there is a dividend payment, and of course you're coming up with the ending balance. So ending balance of common stock, ending balance of retained earnings, ending balance of other comprehensive income, and as a total amount. Do you have any question, guys? Okay, this is the last part I want to discuss, the common size balance sheet. Guys, may I ask you, then we're done with the timing. I can ask you to do the following. Please, do you remember how to do the common size balance sheet?
Yes, I think. Like in this cash, I think it's like 2,300
We are
divided by,
getting a percentage of
yeah, it's like
accounts
percentage.
to
So
total assets.
total assets
Cash
is like
to total
100%.
assets, yeah.
and
Yeah.
it should add up to 100 at the end.
So my question to you, please make the common size balance sheet at home for the Wednesday and prepare some interpretation for it. So how can you interpret in terms of size, in terms of liquidity, in terms of debtness? How much debt they borrowed? Liquidity, debtness, and size.
One moment, please.
I'm gonna write it now. So for me, it's more important, convert them into common size balance sheet, comment on liquidity, solvency. Solvency means like long-term debt. How much long-term debt do they have? I just want to have, I want you to have, I want to hear your opinion, your critical thinking before we proceed about the common size. When you common size and what you see, these are two different companies, East and West. Okay, let me just take a snapshot of it. I'm gonna send you. This one, you're gonna take the, okay. If you don't have any questions, I will stop in here and I will continue with the people that I just arranged the meeting for after class.
Thank you.
You're welcome. Yes.
Thank you very much. Goodbye.
Bye.